I'm Professor Indra Abeysekera. Let's look at how we eliminate intergroup transactions that relates to depreciable non-current assets. When a non-current asset is transacted within the group, the entity that sells the non-current assets, in this instance, we take it as a gain or profit. And the receiving entity would receive that asset and record it at an overvalued amount. Because it's an intergroup transaction, that gain becomes an unrealized gain for the group. And the overvaluation component in that asset of the recipient entity is also not counted for the group because that shows an excess value for the asset. So in consolidation, to correct this situation, we need to eliminate these components. And when we eliminate these components, because we are changing the gain situation and the overvaluation situation, it will give rise to taxation impact. The first thing we need to realize here is that the transaction is a buy and sell transaction. And when we eliminate these transactions, we need to eliminate these transactions in full, regardless of the proportion of ownership in the subsidiary by the parent. We eliminate in full because the parent controls the subsidiary, and when it comes to the control, there's no proportion that's applied for the control. Either the parent controls, which is the case in consolidation, or there's no control, that means there's no consolidation. So we eliminate unrealized gains and overvaluation in full. So if we look at an example here, the parent acquired 80% of ownership in the subsidiary on 1st of July 2018. And in the current year, for this example, starting from 1st of July 2019, the subsidiary sold a machinery for 20 million with a pre-tax gain of 4 million. What it means is that the carrying value of that asset that the subsidiary sold is 16 million. That 16 million comprised of 25 million cost less 9 million of accumulated depreciation. The income tax rate is 30%, and the depreciation rate that's applicable to all members of the entities in the group is 10% per reporting period and applied on a straight line basis. So to record consolidation journal entries at 30th of June 2020, we can understand what has occurred in a picture form. The subsidiary had an asset with a cost of 25 million and 9 million of accumulated depreciation, given rise to a carrying value of 16 million, was sold to the parent entity for 20 million, making a gain of 4 million. At the time of the receipt of the asset of the parent has recorded the cost of the asset as 20 million, and the accumulated depreciation there is at the time of the receipt of the asset, and recording it is 0 for the parent. If we look at from a general journal perspective, from the subsidiary's perspective, subsidiary had an asset which it sold. So we reverse accumulated depreciation by debiting 9 and reverse machinery by crediting 25 to prepare it for the sale. For the asset, subsidiary received 20 million with a gain of 4 million. The parent recorded that machinery at 20 million by paying cash of 20 million. These are general journal entries for individual entities, and if we combine them to make it a summary, the cash cancels off. There is machinery on both sides, and the net value becomes 5. So machinery, a credit of 5, a gain on sale of 4, a credit, and accumulated depreciation of 9, debit. So this is the summarized general journal entry, which is invalid transaction for the group and must be reversed. It is this summarized general journal entry that we are required to reverse. As a consolidation journal entry, we need to reverse this entry, and when we reverse this entry, we debit the gain, which is otherwise a credit, and then we have to reinstate the machinery cost and the carrying value of the purchase price of the machinery is 20 million, but the cost of the machinery was 25 million. So to make it 25 million, where the machinery cost is now recorded by the parent as 20 million, we add another 5 million by debiting machinery cost 5 million. We need to reinstate accumulated depreciation. So we credit a 9 of accumulated depreciation. So what we can see here is that we debited for the unrealized gain of the sale of the machinery, and then we credited for the overvaluation, and that credit for the overvaluation comprised in 2 accounts, machinery cost and accumulated depreciation. If we take 9 the credit and 5 the debit, the net amount is a 4 of credit. So therefore, that debit of 4 equals a net credit of 4. Now that we have reversed the gain and the overvaluation of the machinery, because we decrease the gain or the profit in the group, the income tax expense in the group will also decrease by 30% of that value. So we credit income tax expense 1.2, which is 4 million into 30%. The machinery, effectively, we have decreased the value of the machinery because 9 credit and 5 debit has a net effect of 4. So what we mean here is that because we are now decreasing the machinery cost, as a net effect, there will be less expected future cash inflows. When there is less future cash inflows, there will be saving on future taxes, and 4 into 30% becomes a deferred tax asset 1.2. So the taxation impact of the unrealized gain and overvaluation is a debit deferred tax asset and credit income tax expense of 1.2 million each. Because the asset transaction took place at the beginning of the current year, the asset that was received by the parent, which is recorded at an overvaluation because the carrying value was 16 million and was bought for 20 million. For the group, what is applicable is the carrying value, but because it is now stated at 20 million and the parent has depreciated the asset at 20 million, we need to decrease that excess depreciation expense that is in the combined entity or the consolidated entity. To decrease depreciation expense, the depreciation rate is 10% and 4 million is the overvaluation. 4 million into 10% is 0.4, and we credit depreciation expense of 0.4 and debit accumulated depreciation of 0.4. The reversal of excess depreciation in the group due to business combination will give rise to a taxation. The taxation arises because now we have decreased the depreciation expense. When we decrease the expenses, the profit increase. So the fourth journal entry is for the taxation impact due to reversal of excess depreciation. So 0.4 into 30% is 0.12. So the income tax expense now will increase by 0.12 because we decrease the expenses. The asset has been now used for a year. When the asset has been used for a year, the tax saving that could arise from the asset will also decrease. So we credit the deferred tax asset 0.4 into 30%, 0.12. When it comes to asset transactions, there are 4 sets of journal entries. The first one is the reversal of unrealized profit and overvaluation. The second is the taxation impact on the reversal of unrealized profit and overvaluation. The third is the reversal of excess depreciation in the group due to the business combination. Fourth is the tax impact that arises due to the reversal of excess depreciation.